Hello everyone, welcome to this FT panel discussion on M&A activity. My name is Kay Wiggins. I'm the FT's Asia financial correspondent based in Hong Kong. Before that, I was the private capital correspondent at the FT in London. I also write for the FT's due diligence newsletter, which is our daily premium briefing on corporate finance, M&A and private equity. I can only imagine that a lot of you are watching as maybe something of a distraction from the US election news today. So I hope we can provide that to some extent, although of course we will be discussing Trump and what today's election result means. But our topic today is deal making in the EMEA region, what to look out for next year, and how to navigate a kind of ever more complicated environment in which to get deals done. I'll kick us off with some opening thoughts, and then we'll bring in our panelists for a discussion. So in Europe, the number of deals struck this year fell 23% in the first 9 months of this year, down from already relatively low levels in 2023. But the value of those deals was actually up by 32%, even as the number of deals was falling. The trend was the same in the Middle East and Africa regions, so a higher value of deals, but a lower number. That's all according to data from LSEG. Everyone watching presumably be aware of some of the factors that have stopped a lot of the deal making. So they include higher interest rates, especially hitting private equity firms, which rely on debt more than others, a lot of geopolitical uncertainty in a year of elections, tougher regulations, particularly in the US, and of course the kind of yawning gap between the prices that some groups paid for companies at the top of the market a few years ago and the valuations that they might get for them today. But there are also, on the other side of things, kind of a few factors spurring on some deal making. So corporates increasingly under pressure to generate growth. Sometimes they're finding that looks a bit easier to do at the moment through acquisitions than it might be organically, especially in economies where growth is slowing. The UK in particular as well is also a place where a lot of deals are happening, or at least being pitched. So there's been bids for listed companies like Tate & Lyle, Royal Mail, some big household names, also Hargreaves Lansdown. So there's been a bit of activity there. And the other sort of driver of growth, I suppose, is private equity groups who are beginning to get some pushback from their investors, from their LPs, when they try to raise new funds and their investors are saying to them, hang on a minute, why don't you return us some of the cash from the previous funds first? And so that's kind of putting them under a bit of pressure to find creative ways of getting deals done. So it's putting a bit of pressure on them for exits. So that's a lot of stuff to talk about. And I'm pleased to be joined by a great panel today to go through all of this and more. We have Vanessa Blackmore, who is a partner at Sullivan & Cromwell. We have James Liddy, who's head of gaming, logistics and leisure investment banking for the EMEA region at Jefferies. We have Edward Judry, who is head of investment banking at J. Safra Saracen. And we have Merlin Piscatelli, who is chief revenue officer for EMEA at Datasite. Before we get started, please remember that you can ask questions at any point during this session using the box on your screen. Please do keep those questions coming in and we will get through as many of them as we can at the end of the session. But let's kick off with the big story of today, which obviously is the US election. We'll start with a question for all the panelists, which is what do you think Trump's victory today will mean for the global economy and particularly for investment? Vanessa, let's go to you first on that.
Thanks, Kay. I think the first thing to say is that, it's a very clear victory for Donald Trump. And so, that should resolve uncertainties that would have been hanging over potential deal making. I think if you look at the sort of agenda, what stands out to me is that there are four things. One, deregulation, particularly sort of financial and energy sector, tax reduction, tariffs, and a crackdown on immigration. So I think, in terms of overall sort of international trade, it remains to be seen, how that's going to impact all of the economies, I think, in Europe and elsewhere. And, I think generally speaking, whenever there's a sort of presidential election, you see this sort of dip and recovery So, certain quietening of the markets usually happens around sort of Q3 of a presidential election year versus what's gone before. And you see then an uptick in the first quarter following. So I think that, there's a lot to digest, but I think that, we'll be seeing sort of a growth agenda, and impacts on global trade that we have to wait and see how that all pans out, and whether it's going to be more extreme than it was, say, in terms of Donald Trump's first term.
Yeah, exactly. James, in the conversations you've been having so far today, whether that's with kind of colleagues, clients, other stakeholders, what are you hearing, and what does the reaction seem like so far? I take it, I can accept that this is the early hours of the results, so possibly not too much, but what are you hearing?
Look, I think the market was broadly expecting this in the last few days, although there did seem to be some Harris momentum coming into the last couple of days. But I think the market has priced in what was going on. We've seen the futures are up, bond yields are up, the dollar is up a lot, which probably means that the market's expecting expansionary fiscal policy. Bitcoin's up. If you're in Bitcoin, well done. You've had a good 24 hours. But I think the expansionary fiscal policy we're all expecting probably means that good signs for economic growth, but not a great sign for inflation. And so if you'd priced in another few hundred basis points of Fed cuts over the next 18 months, I'm not sure that that's going to happen anymore. So we'll have to see how that will play out in Trump's sort of first term, and how he manages fiscal policy. Because obviously, I think one of the key lessons we've learned here is that the general worker in the US is quite unhappy with their own fiscal situation and their own financial situation. And so I think Trump's going to have to carefully manage that interplay between monetary policy and fiscal policy going forward.
Yeah, and interest rates particularly, I suppose, a thing for the PE groups maybe. Edward, what are your first thoughts on this?
Yeah, look, I'll echo Vanessa's point. I think that the fact that there's a decisive position, I think, is good. People have been sitting on the fences with respect to launching processes or even pausing potentially, seeing deals go over the line. I think this will mean that activity will start because the corridor of outcomes has now started. I think the interest rate point is quite interesting in the context of PE, because in a world where a lot of the, call it, shackles on deal making has been capital structure, as people see where debt levels bottom out, or ultimately where debt levels may stay in the medium term with respect to ultimately how they seek to price assets. This probably suggests that any material significant cuts are not going to be happening in the next 2 to 3 years. So with that sort of more structural backlog of you need to make a decision with regards to exits, therefore people need to get on and do some deals. I think my only other final observation would be actually picking up on the regulatory point. I think especially in the tech sector, where I spent quite a bit of time, you've seen a lot of big tech be kind of completely off the fences with respect to M&A. They've been very troubled by some of the protectionist stance around doing any deals. I think some of the mood music suggests now that actually this will support a lot of the sort of Silicon Valley economy as they seek to start some of that M&A engine again, where it's been very muted on the tech side.
Yeah, interesting. And Merlin, presumably you might have seen in your data some of the effects of the slowdown or the caution running into this period. What are your takeaways so far?
Yeah, I happen to be in America on a business trip. I'm based in London for the last 18 years, but I happen to be here for an executive meeting. And so I'm here and haven't really gotten out of the hotel to take a pulse on the streets. But I think I agree with what everybody said already. Stability is key for M&A, the M&A markets. We had 40%, I think, of the world's population vote this year. So we've had a lot of instability across many of the geographies, in EMEA in particular, right? The UK, France, where we've had this uncertainty of elections that I think have impacted. When you mentioned 23% down, my numbers were slightly better than that at 14% down, but give or take, it's down. The M&A volumes this year, and I think some of it has to do with elections and that instability. So having this be decisive victory, whoever you're for, it's regardless from an M&A markets perspective. I think that decisiveness and stability will open up the markets to transact, because it has been a pretty dismal last couple of years in terms of M&A volumes. So expectations are election complete, transactions start to happen. And we see that in the data, which I can kind of just quickly mention, but I mean, we've already seen that people building September and October record number of new projects coming onto Datasite, looking at like 28% increase year over year, and a significant just overall number of deals that are looking to go live within the next 30 to 90 days and looking to complete in the first half of next year. So positive trends towards the leading indicators, which we see on Datasite.
Right. So yeah. So in the last few months, people have been getting things ready so that once the election is out of the way, either way in the US, they can move more quickly, essentially. Yeah. Interesting. Correct. Okay. Right. This is probably a good moment to bring in the audience, and we've got a question to ask of the audience. We'll go to a poll. To vote, you can just follow the instructions, which should hopefully be on your screen very shortly. You can scan the QR code there, and there's a little hashtag there that you can enter. Just give you a second to scan that and to load it up. When you get there, you will see that the question is, where might the most M&A opportunity lie in 2025 for this region, for Europe, Middle East and Africa? Their options are cross-border transactions, corporate strategic transactions, divestitures, liquidations, carve-outs, exits or bolt-on acquisitions, and debt financing, equity financing and fundraising. So I'll give you all a little bit longer just to scan the QR codes and enter the hashtag on Slido, and then we'll be able to see what you all think. Here we go. Okay. Give you a few seconds to let them jump around a bit. Okay, looks like C is the clear winner. So divestitures, liquidations, carve-outs, exits, or bolt-on acquisitions, which is interesting because it gets onto this theme of how people might be becoming a bit more creative in terms of the way they have to start thinking about deals these days. But let's bring in the panel. Does anyone have any kind of first thoughts on that? It's pretty clear margin there for people saying that the focus is going to be sort of sales, exits, carve-outs, liquidations, that kind of part of the market. Is that a surprise?
I'm happy to kick off, Kay. I think no, right? In the short term, I think with my private markets focus, as you referenced at the start, the structural factors around private equity remain that they are sitting on $1 trillion of dry powder, which they need to deploy, part of a broader ecosystem of how they're going to fundraise their next funds. You've got a wall of assets where they need to exit, and ultimately people have been sitting on the fences when they're waiting to see, when the outcome is there. So I think structurally, it kind of has to happen. I think as you touched on, we have seen a bit of band-aid liquidity with continuation funds or some minorities and secondaries, but these transactions are still done in the context of an eventual exit. And I think, really what I'm hearing in the new vogue is, right, it's not IRR, it's DPI. And actually that's really going to be the fundamental underpin of the private equity industry, because there is going to be some winners and losers, and that may even lead to some certain consolidation at managers, et cetera, et cetera. So I think, the PE exits, I think fundamentally will need to start. And I think I see that significantly in a number of the processes, which, Merlin touched on, which are really gearing up to hit the window first, because I do think there's a difference between certain assets which want to exit and can exit, and those ones which can exit are the ones which are going to be first out the gate.
Yeah, well, one thing I often wonder is, back in sort of 2020, 2021, to some extent 22, there was this kind of rush of deal making, especially in private equity, and people were paying really, really, really high multiples. You'll all remember this for some companies. Some of those that were bought at the top of the cycle were very high valuations. Is anyone yet starting to see signs that PE firms are actually sort of really willing to just move on those now and get out of them, even if it's not necessarily a price that they would have wanted?
Yeah, just a quick comment on that. I think the hold periods for PE-backed assets for now is kind of starting to hit almost all-time highs, and I think the percentage is something like 55% of them are over 5 years. And so you're really now starting to see where they're going to have to do something. And I think some of the alternatives are not there anymore. And so you are going to start to see them have to exit at potentially a lower rate of return, and then hope that within that fund they had some assets overperform to balance the books. But you're going to, especially as you go into a new round of fundraising, you're going to get looked at in that previous fund. And so we are starting to see some of that come to market where it may be loss making, but you need to move it out of the fund.
Yeah, I agree with Merlin and Ed there completely. And I think with leverage finance markets have been open, and I think most of the deals we've seen this year though have been opportunistic deals. So 3/4 of the deals being done are being opportunistic, extending credit terms, refinancings, etc. We've and only seen 25% being LBO backed deals, which is sort of the polar opposite of what the market's been like for a very long period prior to the raising cycle we've now been through. But I think if we do see a stabilization in rates now, and it's unlikely that they go down again if this expansionary fiscal policy materializes in the US, then funds are going to have to realize that there's no financial gearing that will allow them to maximize returns in the near term if they hold on a bit longer. So that bid-ask spread between buyer and seller will continue to narrow, and the desire for liquidity will take over ultimately. So we are expecting to see a lot more. And as Ed rightly points out, that the trillion in dry powder that's sitting on the sidelines is aging. I mean, that there is a time limit on that investment. And if you want to raise a successful fund in a few years' time, you need to prove to your investors and your LPs that you managed to raise, you managed to deploy, and then you managed to realize your investments in whatever strategy you're pursuing. So the time limit is going to become more and more prescient.
Yeah, exactly. And Vanessa, does that tally with what you're seeing? Are you seeing them looking at more creative ways to get out?
Yeah, I think the received wisdom is that, private equity should sort of turn the assets every sort of 5 to 7 years. But I think that, that isn't entirely true, as Merlin pointed out. And, it's quite hard to sort of pin down. And I think, when you haven't got easy open exits, through the IPO market, and, maybe buyers are not there, then you do have to be creative about how you create liquidity for your investors. So, we've seen, the increasing rise of continuation funds. We've seen sort of, dividend recaps that have been funded, through the debt markets. We've seen, sales of minority interests. All of this is with a view to giving existing investors a liquidity opportunity and, the opportunity to bring new investors in. So I agree with everything that the other panelists have said, and I think that, there's no sort of strict rule book. I think you have to just respond to the markets and be creative about how you provide liquidity for your LPs.
Yeah, I mean, we reported recently on one of the biggest dividend recaps that we'd seen in years, which was this. You will have seen the claim de Blier and Rice on Belron, the kind of windscreen repair company. I think it was a 4.4 billion euro dividend, which was huge. I mean, there's a lot of this going on, and it's a feature of partly of the debt markets, obviously, as you say, and partly of willing to hand some money to investors. But is there a sense in which this might be sort of some of these temporary solutions that, like, somebody earlier called them a sticking what do they call it? A band-aid solutions? I mean, how long can they be effective as band-aids for? What are people's thoughts on this?
Okay, I actually think
James, was that you, the band-aids thing?
If we're going to talk about secondary market activity, I think this might not actually be a band-aid. This might actually be a new strategy that we see lasting much longer and a new thematic appearing. I think we've seen 135 billion of secondary market deals being done this year. And a lot of those strategies have been GP-led. So basically private equity sponsors who have high-quality businesses that might continue to have strong growth outlooks and strong performance outlooks, where they might want to continue managing the asset and not realize the performance of the business in the near term. And so we're actually seeing significant pockets of capital being raised now purely for that strategy. So I think the Jefferies PCA team, and we have over 100 employees that are focused on this sector now across the world, believe that there's been 150 billion in capital raised to seek secondary opportunities by GP-led situations. So I think that's one opportunity to provide liquidity for some LPs and provide an opportunity to roll for others that will be pursued, I think, pretty aggressively through into the next year, which has been happening a lot this year.
Yeah. And Merlin, sorry, I think you were trying to say something earlier. Do you want to?
No. I just think there's all of that is market led. I think the PCA transactions in the private markets are 100% open. I think there's not a lack of quality assets out there, but through the financial times that we've gone through and interest rates rising, I think that's still going through a number of businesses and impacting a number of businesses. And so when you look at optionality that is out there to deploy, private markets are one of those options for good assets that you, like James mentioned, that you'd like to maintain ownership of that good asset because you see that you can get a higher rate of return by holding that asset instead of potentially deploying somewhere else. But I do think we have a market that is divergent in that way, that we have locked or trapped capital versus capital that you can put to work in whether it's a continuation vehicle or private markets, as James and Ed have mentioned. So I think it's just an interesting time, and as things flow through the market, we've even seen administrations I think are up 7% in the UK. So you do have that market that tends to diverge after an economic impact such as these interest rates rising that we've all experienced over the last couple of years with inflation and interest rates. So time will tell, but I think we're seeing some interesting things in the market where people are exploring different options, and they'll continue to do that because the finance world is quite creative when they need to deploy capital or need to get deals done because that's what we all live on.
I think the interesting point then, I think the interesting point though actually is going back to actually good old fashioned deal making of what are the business fundamentals. It's actually not about the financial engineering, is what is the operational improvement. You don't need to necessarily believe that the exit multiple has to increase. Is there truly a strategic buyer for this, and are you creating a strategic asset? And ultimately, if there's to be a public market exit where the bar for that seems to be pretty high for the quality of assets which truly can exit, and actually the markets which you can exit them to typically tend to be the US at the moment. Actually, it's I think putting an increased lens on those in the private equity community and how they actually do their deals and do the diligence. I think we're seeing a lot more focus therefore on the thoroughness, the approach. Gone are the days now launching a sell side process where, here's the teaser, let's go. It needs a lot more thoughtful curation. There's a lot more time in the pre-marketing. There's a lot more time, spending with maybe some of those more wildcard bidders, whether that be strategics or you touch on the D transaction, family office groups, which are getting a lot more active and sophisticated, or even some wildcards. I mean, in our new setting on the private banking side, yes, for more trophy assets, but people have called up saying, can you go and find a random individual who can afford this? So I think it's quite an interesting point that, there is a shift in mindset of what deals can get done. It's going back to much stronger fundamentals than just purely an arbitrage of capital structure.
Yeah, that's interesting. And Merlin, you probably see this in your data, right? The point that Edward was making about processes taking longer and the sort of data rooms having to be much bigger and more complicated than before. Is that that's the kind of thing that you would see if it was happening, right? Is that something that's going on?
Yeah, and in doing this 18 years, really, you kind of see these pendulum swings, and this is, we are in currently a buyer's market where in a typical buyer's market, you see due diligence increase, you see question and answers, the amount of Q&A that takes place through due diligence increase. We've seen the volume of content loaded onto the platform increase by 30% year over year. Why is that? One, there is more content in documents in businesses, but also it's a deeper dive on that business because you can tend to kick the tires for a longer period of time, which we've also seen increase 1 month from year over year, an increase of almost 1 month of due diligence from starting a project to actually closing a project. And I think that all speaks to the market that we currently see in, where it's an okay market. It's not a good market, but it's trending towards a much better market next year. I mean, when we talk about what's going to happen next year, but I think to answer your question, yes, we see it in the data. We see an increase in the length of time for due diligence. We see an increase in the amount of content that is required, whether that's certain work streams like ESG or supply chain, or cyber. We're seeing really an increase across all of the work streams and the content that's required for due diligence.
Vanessa, that must be making your life as a lawyer much more complicated.
Yeah, I mean, I think that I would agree with that. I mean, I think that, you know, if you look back to sort of the very frothy market a few years ago where, you know, there were widely sort of publicized auctions, people went in, it was done very quickly. You know, now it's a much more disjointed process, much more limited sort of universe of people who are, you know, invited in, people signing exclusivity letters at a much earlier stage that then lends itself to a much more sort of thorough, detailed process. And perhaps, you know, it is a buyer's market, so there's, you know, perhaps less conviction on the buy side, you know, that there's sort of less certainty that the deal will actually get done, and people want to make sure they don't leave any sort of stone unturned. And I agree that, you know, for the reasons that have all been discussed, that an acquisition has to make sense from a sort of strategic and basic point of view, and it's not sufficient in given, you know, the environment that we're in, that you rely on financial engineering. So I think we see all similar sort of trends to what's already been discussed.
Yeah, got you. Okay, well, this is probably a good moment to bring in our audience again to answer another question for us, to frame the next part of the conversation. So if you registered and did this before, it's the same process again. Scan the QR code and you should see the question come up on your screen. So this time we're asking what sector will see the most deals in 2025 for EMEA? So TMT, industrials or chemicals, consumer and retail, business and financial services, pharma, medical, biotech, or energy utilities or other. So we'll give everyone a few moments to get their thoughts in about where the most active sectors are going to be next year. Right, often in these questions, TMT is in the lead, which is interesting. It's dropping from prominence now. Oh, there we go. I'm rigging the vote as I speak. We'll give it a minute more to settle. But yeah, okay, it seems like TMT, pharma, medical, and biotech are the ones that people consistently seem the most excited about, or at least seem to think that they'll be the busiest next year. Does that tally with the experience of, I mean, I guess, James, you're sort of specializing in some of this stuff. What does this tally with sort of your experience? I guess everything's a tech company these days, but is that what you're expecting to see the busiest bit of the market?
Undoubtedly, the opportunity set in the TMT space is going to continue to be ever growing with the advent of generative AI and other opportunities in the space. But I think it's interesting to see industrials being so low there, because if you look at year to date, industrials really has been the driver of activity. And really, corporate industrials, M&A has been the big driver of activity. I think it's accounted for almost 40% of the market this year. And healthcare has actually been the laggard, whereas obviously coming out of COVID, healthcare had a significant boom, which has sort of come off a little bit in the last 12 months. But undoubtedly, TMT will continue to be the stalwart of the sector. So there's technology bankers out there, and lawyers will continue to do well, I think.
Edward?
Quick comment on that.
Yeah,
we see that exactly in our data. TMT kind of leading the charge in terms of new projects started. But I agree with James. It's been healthcare, life sciences have really hot coming out of COVID, and then really took a bit of a dip. But we are seeing the early signs of that being recovering, and a lot of deal activity or pre-deal activity is happening in that space. So our data kind of confirms what James had just mentioned.
Yeah, I think I'll echo that with a couple of observations. I think when you start to look at the structure of the industries, though, some of the M&A activity differs by the maturity curve of the companies. I think one big theme, which certainly echoes across, industrial services, is around corporate simplification. You've increasingly seen, especially PE, where they don't want to believe in the operating leverage, that they can ultimately acquire businesses where there's things to be done. And that certainly leans itself more to industrials and business, and I'd say very much professional services. There's been a lot of headlines recently around accountancy, consultancy, where the businesses have grown actually quite complex, and people are looking to rationalize that. And so my other observation is in financial services, because I think you're coming off obviously a higher rate environment where a lot of banks, a lot of financial institutions have clearly made a lot of money through net interest margin. but equally they're finding disruption and the ability to adopt to some of the digital age and how they seek to do that. And I think we're starting to see some green shoots of some of that activity converging between old and new with respect to financial services. So I think actually that's an area where it might surprise some, where some of these businesses seek to go.
Yeah, interesting. Okay. Well, maybe we should. So that's the moment when we're talking about the especially the TMT sector is AI as a driver of this. I'm loath to bring in AI into every conversation because it feels like it always is. But one thing that's very notable is that it does feel like that has been where all of the kind of exuberance and froth has migrated to, anything with AI in the name. And I wonder if any of you guys have come across a kind of smart, thoughtful, kind of calm ways of approaching the need to get into AI, whether that's through M&A, whether that's through other forms of deal making. Like, are there sort of people out there who are just kind of managing to find ways to get ahead of the AI trend and do it smartly, and rather than sort of rushing into companies that maybe overvalued?
I'm happy to lead on that one. So
go for it.
It's a leading question. I apologize.
It's a leading question. Look, I think the key question all around the AI is the so what and what does this achieve? And actually, where I've seen some of the more interesting discussions I've had is as you start to go into the ultimate data feed, and as you seek to vertically integrate into the so what of structured data and where that's coming from, and that goes from companies which are computing that and putting that together, or even the actual feedstock, whether that be media companies and how that ultimately then gets used. I think on a relative basis, when you see the valuation levels where you've got companies with a concept raising 200 million of equity, right, because they worked at DeepMind, compared to actually business with 100 million ARR dealing in structured data, I know where I personally be placing my bet. And certainly, if I was trying to get ahead of the curve, I think that's the place where some of the future proofing's really done than some of the more conceptual sort of model stuff.
Yeah, I mean, I certainly think in the public market context, it's been really on the hardware side that has experienced the most benefits from this AI trend, whether that be the chip manufacturers or even the energy producers and the data center providers. So I think that really shows that I think the market is in general agreement that AI is a huge disruptive wave. No one's quite sure exactly how that's going to manifest in terms of day-to-day operations of business and what efficiencies that'll bring to the operations of companies. But everyone, I think, is in general agreement that this is going to be a huge trend and a intergenerational trend that will continue for some time. But it's going to use an enormous amount of energy. It's going to use an enormous amount of computing power. And therefore, it's quite easy to deploy capital into those, as Ed said, some of the feeding and some of the pipelines that rather than in the end markets and how it'll actually manifest itself in the corporate world over the next 5 years or so.
Yeah, data centers definitely seems like a place that we see a lot of people rushing into. Vanessa.
Yeah, I was going to say, look, I think it's one of these things that has the potential to pervade all aspects of life and business. And if it's correct that AI is going to be this huge transformational sort of development, much in the same way that perhaps the internet was 30 years ago in terms of the commercialization of the internet, I think there's an element to borrow from the sort of New York lottery. You've got to be in it to win it. And, there's a risk that if you don't invest and, invest by acquisition rather than sort of grow organically, that you risk missing out. And that's almost worse than, investing and not quite getting it right. There's always going to be winners and losers when you've got these huge sort of transformational shifts happening. And I think that's one of the real sort of dilemmas. What do you do about this? Do you buy in these sort of capabilities, and how do you prove it? Or do you develop them yourselves, or do you just sort of watch by the sidelines and sort of wait and see? And all of those strategies, have risk with them.
Yeah, absolutely. Yeah. Okay, well, just a quick reminder to the audience, by the way, to keep getting your questions in using the box on your screen. They are coming through to my screen. I can see them, that we've got some really good ones. So I'll make a bit of extra time at the end to get through some of those. But sorry, Merlin, you wanted to come in.
Yeah, just a quick comment on AI. I mean, I think if you think about specifically how does AI impact M&A, it's quite interesting when you think. So one way people are investing, because I think when you look at a law firm or you look at a consultancy or you look at they sit on really sensitive, confidential, market-moving data when you're talking about M&A, and so the application of AI I think it's been a change management exercise, and also a risk adverse as people think about how they could utilize AI to speed up deals. We talked to some 650 deal makers, and they all, or 50% of them, feel that AI will speed up the deal making process. But you got to think about it's a hard industry to change. So where does it start to change, and then how can you create those incremental changes that then over time you see a much more efficient deal process? When you think about content, right? What does a deal, when you kick off a deal, you are getting a lot of content from your client and then sifting through that content to organize that content. If you think about AI utilizing and being able to categorize that content, what about search, right? You need to search across that content, understand where the risks are, understand where the opportunities are. And right now you're kind of hunting and pecking through that content and not necessarily using search capabilities to interrogate that content, so you're more informed, so you can then structure that or present that asset in a different way. If you think about reduction of mundane tasks at a junior level, as these young bankers come into the industries or lawyers come into, they spend a lot of time on things that probably are pretty low value but must do type tasks, that I think AI could be introduced into some of those processes that would create a lot more efficiencies across the M&A life cycle. And then also obviously have more certainty in terms of the outcome. So we're starting to see that at Datasite. We have obviously a lot of AI introduced across our platform, and we're starting to see the utilization and adoption of that really increase, because people are seeing the need to use it from an efficiency gain. But I still think there's a big uncertainty in the world of M&A, just because it's private data, super sensitive, market moving, confidential stuff that we deal with, that there just has to be a level of heightened, hey, wait, let's make sure we're doing this the right way, because otherwise you could have your names in the paper, which you would want.
Which nobody wants except me.
Yes.
I think to Merlin's point, undoubtedly, I think AI is going to help drive productivity, and that's something that the economy has been lacking globally for the last decade or so. And so if we can see a real acceleration in productivity, hopefully we can see an acceleration in the levels of economic growth across the developed world, and then increase in living standards and et cetera, and all the benefits that come with increased productivity. But so I think that's really going to be hopefully the big macro theme that we see now over the next 5 to 10 years. And with some stability in the financial markets and stability in the geopolitical environment, hopefully that means a very positive outlook, or a stable outlook at least, for deal making over the next 5 years or so. Yeah.
Okay. Well, before we go to the questions from the audience, I was going to come on as well to talking about the UK. I mean, this is something we've been covering quite a lot in the FT. The kind of uptick in bids for UK listed companies. I think I mentioned some of them at the top of the call. So Tate & Lyle, Royal Mail, Hargreaves Lansdown. There's also this BHP bid that we've written quite a bit about for Anglo American, which is London listed. That's obviously in its sort of standstill period at the moment, but that will end this month. So we'll watch the space for that. But it seems like there has been this rush into UK listed companies out of a view that perhaps they're slightly undervalued. I wonder how much more of that you think we might be like to see in the next year or so, and what the early indications are in terms of how the Labour government, the relatively new Labour government in the UK, responds to this trend. Vanessa, is that something you've been keeping an eye on?
Yeah, I mean, like, I think there's been a lot written about, since 2016 and the Brexit vote, about, how, valuations have decreased, and, the currency has weakened sort of relative to the dollar and the euro, since where it was back in 2016. You've also seen sort of, PE ratios sort of decline relative to sort of where they are and to them elsewhere. My view on this is, though, that mostly people do M&A for strategic reasons. And so, in terms of, whilst the stocks may be sort of cheap relative to others, I think there still needs to be, and the bankers will give a view on this, but there still needs to be some other reason or strategic reason why an acquisition makes sense. You don't just buy something because it's cheap. It needs to fit with what you've got and make strategic sense. So there has been quite a lot of action. I looked at the sort of takeover panel list of things yesterday, and this, I think if you include AIM as well as the main market, there's been over 100 deals, including people that have put themselves up for sort of sale or strategic review. So that's quite a lot. And some of them, like the Anglo-American, the BHP approach for Anglo, that was would have been a mega deal. You've got Carlsberg bidding for Britvic. That looks to me to be something that they're doing because they want to diversify their portfolio. There's all sorts of reasons why these deals happen. You've got International Paper, making its bid for DS Smith. But so I personally, I don't think that companies ever buy another company just because it's sort of cheap. It has to make strategic sense to do a deal.
Yeah, I suspect sometimes in the private equity industry there is slightly more of that than there may be in the corporate world. But yeah, I can see what you're saying. We're getting some really good questions in, by the way, from the audience. So I'll have a look at those for now. So we've got one that's specifically addressed to James. So it says to James, to follow up on secondaries. I think this was referencing a point that you made at the beginning of the conversation. To follow up on secondaries, do you now expect GP-leds to take a majority of the market in 2025 versus LP-leds, as they seem to be rising faster? And what is the average or median exit size in a GP-led? There's a slight bit of jargon here, and we should possibly explain the GP-led, LP-led distinction, which is. I think
that is a great question, because GP-leds is when basically the manager of the fund initiates this process and wants to put it into put an asset into a continuation vehicle, etc. And we're seeing a lot of single asset CVs, continuation vehicles out there at the moment. I think given the flow of capital into the space has been very significant, and a lot of strategies have been raised specifically for GP-led situations. And I think one of the statistics I got from my team earlier was that we think it's around $150 billion now, which is dedicated to GP-led secondaries. And the second trend we're seeing is that there's a definite increase in the check size that the largest or the lead CV investors can undertake. Only a few years ago, it was tens of millions that the lead investor would take in any sort of CV. Now I think we've seen 7 deals this year where the lead investor in a CV has written a check of more than 250 million, and 4 of those deals have been over 500 million. So I think as a strategy in and of itself, we're going to see a lot more activity here. And I think as Merlin rightly pointed out earlier on, and Ed, if these are high quality companies and you can see more value being generated by holding on to them for the next go round, it makes more sense to hold on to them and make more longer term strategic decisions to increase value for your shareholders and your your LPs, rather than just exiting in what might be not the ultimate environment to realize or maximize value for your LPs. So yes, I definitely think we're going to see more GP-led deals, and I think we're going to see more capital dedicated to the space to help bring liquidity to the sector.
Yeah, we've got some good, slightly provocative questions coming in. One of them is quite a simple question in a way. Why are so many M&A transactions not being completed at the moment? I'm not sure if that's true or not true, but Merlin, maybe you've got the stats on some of that.
Yeah, I mean, it's gotten better this year in terms of completed deals marked as successful. But historically, the last 2 years, we've seen a significant drop in deals that are completed successfully. And I think everything we've been talking about, economic environment, very difficult. I see, investment committees that you're going to and bringing a potential investment to. There's been some massive challenges there. Boards risk adverse to, do we do this massive deal now with elections on the horizons, with interest rates where they were? I think that's the instability of the market that we've been living in for the last 2 years. And we've seen that reflect in our data, that you see deals start optimistic, getting to that 11th hour, and then not completing. But the good part is that, one, we've seen that number increase, and we've seen more restarts, mean where people are coming back to us with a previous transaction, with the markets changing, and they're going to bring that market, reanimate that business to the market. And so that's a positive sign that we're seeing that the markets are turning, and we're expecting more successful closes.
Cool. Okay, thanks. We've got another good one actually from the audience. Oh, sorry, go on.
I was just going to say, to follow on from Merlin's point, fundamentally, transactions are driven by stability. When you can make a decision today where you're confident that decision is still going to be valid tomorrow, that creates a conducive environment for doing deals. So whether that's rate stability, whether that's economic environment stability, etc., we need stability. And what we haven't had for a number of years now is that stability. Whereas COVID obviously was a very massive negative to begin with, and then depending on what sector you're in, it was a massive positive coming out of that, whether that's the leisure space or healthcare, etc. And therefore, the stability or the predictability of earnings was difficult to judge and difficult to price. And so I think now what we're seeing the initial green shoots of is some of that stability. Obviously, geopolitically, it's still we're still not seeing that yet, but economically, rates, growth, etc., we're beginning to see the green shoots of stability, which is what's bringing a lot more deals back to market.
Interesting. You think that might change in the wake of today's election results?
Look, I think if you're waiting for rates to decline further before bringing your company to market, obviously there's an inverse relationship between rates and value. You might be disappointed because rates might now stay a bit higher for a bit longer. But having said that, that might also bring about an increased convergence between buyer and seller, with sellers realizing that rates probably aren't going back to zero again anytime soon. So that might bring about a more realistic expectation for valuations.
Yeah. We've got another good question coming in from the audience, which is referencing some stats that we outlined at the top of the session in terms of how the number of deals was falling, but the value of them was rising. They're saying, why has there been such an uptick in elephant deals over the past 12 months, but deals under $1 billion are down? What's going on? Why the mega deals? Edward?
Sure. I think one thing with private equity being on the sidelines a little bit has been corporates have had their sort of moment to shine, because they've actually been able to competitively look at deals without being outbid by a PE. I think they've had the ability to take their time, being more patient. So I think that's driven a lot by some of the corporate willingness to sort of have that time outside from private equity. I also think it goes to some of the more geopolitical points around taking a fundamental view on industries, whether that be AI, supply chains, or just geopolitically, some of the cross-border activity. And it might just be the time to repivot those business models, whether it be insuring capabilities, et cetera. And then finally, I think it's to some of the corporate simplifications. Some of those simplifications are selling very, very large pieces of businesses as they actually seek to become smaller. And I think they're the sort of three components of why you're seeing that trend.
Got you. Vanessa, do you want to have the last word?
I agree with that, actually. You're seeing, I think that there are macroeconomic reasons with depressed sort of growth. It's having a negative impact on valuations. You've got private equity on the sidelines, as Edward says. But, where for a corporate, if a deal makes strategic sense and, the debt markets are open for investment grade issuers, you can fund, people excuse me, they can do sort of secondary offerings to raise funds in the capital markets. While, you know, there might not be very many IPOs, there are people are able to do sort of placings of equity and raise funds that way. So I think the strategic buyers are in a relatively good position at the moment in the market. And, you know, we have seen some mega deals, but you're also seeing, and I think there is actually an uptick in some of the sort of smaller deals, and again, it's sort of slightly geographic. I mean, if you look at Southern Europe, that there's been a lot of activity, you know, in the slightly smaller bracket. So I think activity is alive and well. It might be down, and with all things, you know, there's always a bit of a mix.
In the compare, I'll just add that the compare, right? It's year over year.
We're right up on time, Merlin. So tell us quickly. Tell us quickly.
No, I was just saying it's year over year compare. So when we say it's down 13, 14, 23%, that's a year over year, which last year everybody would reflect on was not a good year for M&A. But we are seeing a definite green shoots, as James mentioned and Vanessa mentioned. So I think the future is looking very good. And so I wouldn't overly be concerned with the volume data.
Interesting. Okay. Well, on that note, thank you very much, everyone, for sharing your thoughts with us today. Really appreciate the conversation. And thank you, everyone, also for listening online. And thanks also to Datasite, of course. And just a quick reminder that you can watch this back on demand for the next 30 days, I think it is, on the event website, and you can share it with colleagues as well. But thanks, everyone, very much for sharing all your thoughts today.